Okay, thank you everybody for your patience. My name is Greg Klingler. I'm the Director of Wealth Management over at GIBA. And today we're here to talk about maximizing your pension. Now, at GIBA Wealth Management, we take maximizing your pension, I would suppose, a couple of steps further than you would typically think when we're talking about maximizing your pension. Your pension and your benefit package consists of a lot of different moving parts, and the goal is to get them working together in such a way where we can maximize all these pieces of your benefits to create the retirement of your dreams and effectively fulfill all of your goals, whether it be retirement or even moving to maximizing your legacy on the distant future. We're going to talk about a lot of different things inclusive of your pension. We're going to talk about FEGLI. We're going to talk about the different types of pensions out there. I am going to lean towards the more common pension programs that we're going to talk about today. So we're going to be talking about FERS and we're going to be talking about CSRS. I'm fully aware that there are some other programs out there, especially for our foreign service friends, FSPS and FSRDS. We will talk about them very, very briefly. If you do have questions regarding those types of pensions and how they work, please feel free to reach out to me after the presentation. We'll definitely go into them in as much detail as you need. So the goal of one of these presentations is to put, as you fill out your retirement forms, as you check those boxes, what checks should you make? What actions should you take in order to put yourself in the best place going forward? In many cases, a lot of the decisions when it comes around planning for your retirement, especially planning for around your federal benefits, these are big dollar decisions. These are decisions that I certainly can't tell you what to do because I don't have enough information for you individually, but I can tell you that it is worth your time and it is worth your money to do your due diligence and make sure that you have the right answer for you. So the goal of this presentation is not necessarily to tell you what to do. It's hopefully to provide you with enough information for you to ask the right questions to the right people to find the best answer for yourself when it comes to your pension, when it comes to FEGLI, when it comes to the TSP, and when it comes to matching those all together. All right, so my name is Greg Klingler. As I mentioned, I'm the Director of GIBA Wealth Management. I'm a CFP, and I've been working with public sector employees for the last 17 years. So working with people like yourself is what I've basically dedicated my entire career to, and it's what the financial advisors at GIBA have dedicated, for the most part, their entire careers to as well. We take this very, very seriously, and we take it very personally, helping people like yourself out, because we understand that the mission that you do behind the scenes is incredibly important. So most of you have already heard about GIBA, a not-for-profit organization founded back in 1957 by NSA employees for NSA employees. Back in 1957, we were founded with a very specific purpose in mind, and that was health insurance and life insurance. OPM did not step in and offer these items to these employees, and they frankly needed them. So over the last 65 years or so, OPM has stepped in and they've offered all of these solutions, and frankly, a lot of these solutions, as you've seen during open enrollment with, in our area, about 28 different insurance carriers. So GIBA has continued to evolve to meet the needs of our membership. And today those needs are much more around education, planning, giving people the right information to make the right decisions for their financial futures and for their families' financial futures. We have about 17,000 members and we continue to grow. Wealth management is one of the largest growing sectors of our organization. We help out somewhere around 400 new families each and every year, and we're hoping that continues to grow. So how can GIBA help you? I'm not going to read this slide. I know you can read this slide. There are 3 words that I think really set us apart. Number 1 is experience. In a lot of ways, we are like a family, and we have a lot of longevity in the people who work here at GIBA. We have a lot of experience helping people just like yourself get to a point where they want or they need to be. Expertise. We have financial planners in the office. We have chartered federal employee consultants in the office. We have educated ourselves to help federal employees because, frankly, you are who we are and you are who we help. And the last one, which is I think maybe the most important item, is motivation. Our incentives, our salaries, our company culture, our relationship with the board of directors are all built around one very simple point. We want to make sure that there's no conflict of interest other than helping our members get to where they want to be. So expertise, experience, motivation, that's what sets us apart. This is just a list of our current programs. As you can imagine, dental and vision are very popular nowadays as we've entered open enrollment. If you do have any questions about dental or vision, we are happy to help, and we are definitely able to talk about both our plans and the other plans out there. We can find you the best one that meets your needs. Other very popular plans are our emergency travel plan, auto and home insurance, and our long-term disability program for those of you who are still working. On the right side, I'm not going to get into too much detail. These are just all the pieces of financial planning that can occur. We offer no obligation, free financial planning, or any type of financial planning that you need to our membership. We were put on this earth to help people like yourself. Please feel free to use our benefits as you need to. As a nonprofit organization, we can definitely work a little bit differently than a lot of the for-profits out there. So if there's anything that is of interest to you, balancing your TSP, looking at an old IRA, ensuring you're insured enough to protect your family, putting all of this together into a true financial plan for your retirement, we can do that. All right, so up until last year, I was doing between 2 and 3 dozen presentations in the Virginia, DC, and Maryland area. So if you saw any of those presentations, you may recognize this slide. These are on every single one of my presentations, because the goal of this presentation, while we're going to be talking a lot about the specifics of pension, and we're going to be talking a lot about the specifics of FEGLI, the goal is not to make you experts on the pension or experts in the FEGLI. The goal is to make you experts on how your pension interacts with your TSP, how it interacts with your Social Security and your spouse's assets, and how all of those items commingle together in the most effective way. So again, don't think about this as there's a test afterwards to learn about the FERS program. Think about this as, how does it affect me? What can I do to make my retirement better? Seminar topics. We're going to start off by talking about FEGLI. It is surprising how complex FEGLI has gotten, considering it's just simple group term insurance. Then we're going to talk about the pension systems. We're going to talk about FERS. We're going to talk about CSRS. And I will talk very, very briefly on the foreign service style pension programs, the FSPS and the FSRDS. Then we're going to talk about the survivor benefit. What is it? Are there other options? Should you think outside of the box with your specific situation? And then lastly, and this is going to be more of a taste test than anything else, we're going to talk very briefly about legacy planning. Legacy planning for almost all federal employees should not take place prior to retirement. Legacy planning should probably take place in excess of 10 years after retirement, when you know that your budget is very, very comfortably set. The only reason why I mentioned this today, and I will mention this today, is because everybody should know the next step. It doesn't mean you should go forward with the next step. Just understand that this is the next step, and at some point down the line, you should plan to consider this. All right, one of the big factors that we're going to talk about throughout this presentation is life expectancy. Now, most people, when they hear life expectancy, they see the Department of Census quoted tables. The average age for a man is about 77 years of age from birth to death. The average age for a woman is about 79 from birth to death. I'm showing you numbers that are much larger on this slide. So why am I doing that? Because it's from birth to death, which means it takes into account stillbirths. It takes into account childhood diseases. It takes into account really bad decisions that teenagers and young adults make. At this point in time, if you're listening to this presentation, you are probably beyond that. And because you're beyond all of those items, your life expectancy is much, much longer. So the average life expectancy for a male who's age 65, 50% chance of living until 87. For a woman, 50% chance of living until 89. For a heterosexual couple, and I only use heterosexual as an example because the stats for male and women are different, is a 50% chance of living until age 93. So when we talk about people living post-retirement 25, 30 years, that's not an exaggeration. That's not particularly conservative. That is actuality for many people who are going to be on this call. So keep that in mind. Retirement is not a point in time. Retirement is a marathon, and we should plan for it as such. All right, so why is retirement planning important? Well, first off, retirement planning is important when we start talking about two people retiring. Can their assets, can their pensions, can their Social Security support their retirement needs? But we always do need to take it one step further for people who are married. Because at some point in most cases, two becomes one. And how does that affect the retirement of the person you leave behind? The facts tell us that there's a 20% chance that a woman will outlive her husband by 15 years. And that's true because women typically marry husbands who are older. Women typically live longer. And for those two reasons, 20% chance a woman will outlive her husband by 15 years. There's a 45% chance that a woman will outlive her husband by 5 years. So as we look at retirement, we do need to look at, okay, what happens, especially for you men out there, when I statistically leave first? What's going to happen to the love of my life? How should I plan for that? People are living longer. Back in 1935, when Social Security was created, the average age for a man from birth to death was age 65. Social Security was only created to help against the above average life expectancy. It was never designed for every person to sit on it for 10, 15, 20 years in retirement. And that's one of the reasons why Social Security it has some bad press over the last 15 years and is expecting to run out of money in 2037, at which point the amount that they will be able to pay in benefit is going to be about 79% of what has been promised. And like I said before, retirement is a long period of time. It is not a singular point of time. I work right now at GIBA in more of a management position. Prior to that, I was working with about 300 to 400 families per year talking about retirement. And I heard it an awful lot. People would walk into my office and they would say, Greg, I saved $500,000. I'm ready to retire. Or I saved $1 million and I'm ready to retire. And my comment to all these people was, you know what, that's actually really, really great. The fact that you were able to put aside so much money, you obviously made good decisions because your money grew. These are all really, really good things. But the reality of it is, what is $1 million going to buy you? What's the goal of the $1 million? The goal for most people is to take that TSP, and for most federal employees, it's the TSP, and to turn it into a stream of income that's going to last for the rest of your life. As a back of the envelope piece of math, if we're looking to have a cost of living increase adjustment added on, you have about a 91% chance of success over a 25-year period if you take out 4% starting off. So $1 million TSP would equate to about $40,000 in annual revenue that will grow by 3% per year for the next 25 years with a high chance of success. So your $1 million portfolio, what does it get you? About $40,000 per year. All right, so let's talk about FEGLI. So before I get into these slides, let's quickly set the stage for FEGLI. FEGLI is not a singular form of life insurance. It's actually broken up into 4 different parts. You have basic, which is subsidized by the government. You have option A, which is just a straight $10,000. You have option B, which is the big one, which can be 1 to 5 multiples of your annual salary, rounded up to the nearest $1,000. That's typically the big one that people use to protect their family on, by the way, option B. And then there's option C, coverage for a spouse and coverage for a child, up to $25,000 for a spouse, $12,500 for a child. The reality about option C, if you really do need the insurance, there's a lot better options out there than option C. So let's see how these 4 different types of FEGLI insurance work. So the basic plan. For anybody over the age of 45, it is your salary rounded up to the next $1,000 plus $2,000. So effectively about your salary. If you retire and you choose not to pay any additional money, it's going to start going down 2% per month. until it hits 25% of coverage. At 25% of coverage, it stops reducing. It is free. So whether you need insurance or not, provided you've had FEGLI for at least 5 years, which allows you to take money into retirement, you should maintain your basic plan, let it go down to 25%, and enjoy the free insurance for the rest of your life. Because whether you need insurance or not, free is a really, really good price, and it's something you should take advantage of. Option A works very similar in retirement to the basic option. Option A, $10,000 worth of coverage. It will go down 2% per month, down to $2,500, at which point it will remain at $2,500 for the rest of your life, free of charge. Again, if you have it going into retirement and you've had it for at least 5 years, keep it. Free insurance is a very good price. Option B. Now this works a little bit differently. You can take into retirement any number of multiples that you currently have in effect. So if you started off before you retired with 5 multiples of your salary, you could take 2, you could take 3, you could take 4, any number of multiples you could bring into retirement. Now option B goes down to 0. It will start going down 2% per month for 50 months until it goes down to 0, at which point it will remain 0. Option C works in the exact same way. To go down 2% per month, down to 0. Now there are ways to ensure that it does not reduce. You can effectively reduce the reduction, but ultimately in order to reduce the reduction, you're going to have to pay a premium. For the basic plan, you can reduce the reduction entirely. You can reduce it by 50%. You can reduce it by 75% for a cost. Option A, you don't have an option. It's going to go down to $2,500 whether you like it or not. Options B and C, you can also reduce the reductions. In particular for option B, you can reduce the reduction on any one of the multipliers, any one of the multiples. Now, that's how it works mechanically. In reality, I have worked with about 1,000 people who've entered retirement since I've been at GIBA. And has been in retirement for an extended period of time. And I can tell you the longest I've ever seen somebody hold an unreduced option B in retirement is age 76 years of age. Because it can get very, very expensive because FEGLI goes up in price at 5-year increments in retirement. At 75, you hit a next threshold. This person lasted for 1 more year and then finally had to let their FEGLI go. FEGLI is very, very good to keep if you need it for only a short period of time, typically under 10 years. It's very good to keep if you have a substantial medical condition. It is very good to keep if you are terminally ill. If you fit into any one of those 3 categories, you definitely want to maintain your FEGLI at full charge in retirement. But if you don't fall into that category, there's typically better options. Because as we talk about life insurance, as we talk about going through the underwriting process of life insurance, I like to refer to a couple of what I consider to be underwriting assets or life insurance assets. Your gender. If you're a woman, statistically you live longer, which makes it cheaper for you. So being female from an insurance underwriting standpoint, that's an asset. Being young people have a lower mortality rate than older people. So a younger age is definitely going to be an asset as well. Health. If you're in good health, you typically have a lower mortality rate than being in poor health. So being, let's say, a preferred health class will provide you a much better rate from insurance. When we talk about group insurance, we're talking FEGLI. We're talking about a lot of the insurances that are offered by the benefit side of GIBA, Compass Rose, AFSPA, WAPA. Those are all group-based insurance. They group similar people together with basic minimums, but they don't account for smoking. They don't account for medium health versus good health. So if you're in good health, you can typically get much, much better rates relying on your health, your age, your gender in the underwriting process. So let me just give you a quick example. This is a preferred health rating for a man, a female, and it will show what the same amount of coverage for FEGLI does over the course of somebody's effective retirement. As you can see in the short term, at age 60, FEGLI is cheaper. But FEGLI is going to go up in cost over 5-year increments, whereas the other policies that I've quoted here are permanent in nature. The prices are not going to increase. They're guaranteed for the rest of that person's life until they pass away. So at 60, FEGLI is cheaper. Even at 65, FEGLI is going to be slightly cheaper than that of a preferred woman and pretty substantially cheaper than that of a preferred man. But at 70, we really start seeing FEGLI separate from the pack, and in not a good way. FEGLI is now about 25% more expensive than that of a preferred men's policy and substantially more expensive than that of a woman. And then at 75, it goes up again, almost doubles to almost $11,000. And as I said before, this is about where the longest I've ever seen somebody hold option B into retirement is. And then at age 80, it goes up one last time to $15,000, almost $16,000. I've never seen anybody hit that level in FEGLI post age 80. As I said before, the longest I've ever seen somebody last in full unreduced FEGLI was age 76, and this is why. So if you need coverage post age 70, post age 75, FEGLI is not going to be your answer, and you want to look at other options at your disposal. All right, so let's move back to pension maximization. So what is pension? What is a pension? A pension is a predetermined calculation that's going to provide you income for the rest of your life. Now, when we talk about survivor benefits, we get conditioned to opt into the maximum survivor benefit for one simple reason. Well, two simple reasons. It's easy, and we love our spouse, and we want the best for our spouse. And this button, this opt into the full survivor benefit, seems like the best way to give the spouse everything that they need. But we don't take into account age, health, dependence, and wealth. Because at the end of the day, the survivor benefit, what is it? It's guaranteed insurance. And if you don't think somebody calculated the value of offering guaranteed insurance to people who are in good health and potentially people who are in bad health, you're wrong. This has been calculated. This has been formularically proven, which means if you're in good health, there might be better options out there for you. Take advantage of those underwriting assets, as I mentioned in the last couple slides. So the survivor benefit, again, as I said, is a predetermined portion of your pension paid to your surviving spouse. There's a couple of big differences between this and insurance, though. Number one, the survivor benefit, in most cases, you cannot change the beneficiary. And number two, it is not a lump sum payout, it is a payout for life. And we're going to talk about why those two differences could make a difference. So as we talk about maximizing your benefits in retirement, we talk about FEGLI, we talk about your FERS, your pension program, your CSRS, your TSP. You want to make sure that you think outside the box here as well. A lot of these decisions are big dollar decisions. If you are a CSRS and you take a survivor benefit, over the course of your life, you could easily pay out $250,000. We've seen it. So when we talk about big dollar decisions, this is one of the bigger dollar decisions that you make in your lifetime. So you want to make sure you do all your due diligence. At this point, I'm not trying to tell you what to do. I am just pleading with everybody out there to make sure that you do your due diligence, you look at all the facts, and you make the decision that is right for you. So let's talk about these pensions. So first we have the new system, the employees hired post December 31st, 1983. The next system we have is the older system. So that's the CSRS, or if you're a foreign service person, the FSRDS. And that was available for people who were hired prior to 1984 who did not choose to move to FERS. And then every presentation I typically do, there are one or two CSRS offsets where the calculation is similar to that of CSRS, but the major difference is the pension is reduced and this person gets full Social Security benefits unreduced. All right, so to summarize these plans, The FERS pension is calculated by multiplying 1% times your number of years of service times the average of your 3 highest paid years, and that's average of your 3 highest paid years when we talk about basic and locality. If you reach a certain minimum threshold, that is age 62 and 20 years of service, they raise the multiplying factor from 1% to 1.1%. As part of the FERS three-legged stool, you have access to Social Security, and you also have access to the TSP and effectively the 5% match. Next is the old pension program, people hired prior to December 31st, 1983. Over the first 10 years, you're credited, 10 years of service, you're credited 16.25%, and then after that, you're credited 2% of your salary, or 2% times the average of your 3 highest paid years. You will only get Social Security if you earn them separately outside of federal government service, and if you did earn them separate outside of federal government service, more than likely it's going to be reduced unless you worked outside of the federal government for at least 30 years. You do have access to the TSP, but you do not get the match, and you have access to this thing called the Voluntary Contribution Plan. If you are a CSRS employee and you have not heard about the Voluntary Contribution Plan and you are still working, please reach out to us. It is a way for you to super fund a Roth IRA with up to 10% of your lifetime earnings and never pay taxes again on the earnings. It's pretty powerful stuff. Please reach out to us afterwards. Lastly, we have the CSRS offset. Calculations is the exact same as CSRS, but here's the major difference. At age 62, they will actually reduce your CSRS pension by a percentage of your Social Security age 62 benefit, whether you take Social Security or not. But at that point, then you get unreduced Social Security. You do have access to the TSP, which is not the match. And CSRS offset folks can still take advantage of the Voluntary Contribution Plan as well. All right, the 3 legs of the three-legged stool for new employees. You have a 4% match for the TSP. That's a dollar for dollar match for the first 3%. That's a 50% on the dollar match for percentages 4 and 5, plus 1% automatic contribution for a total of 5%. We've already talked about the FERS annuity calculation. And for those foreign service people, the calculation does get a little bit better with the first 20 years achieving a 1.7% factor versus the 1% factor. Your survivor benefit options are very, very simple with the new pension plans: 50%, 25%, and 0. As I mentioned before, if you reach a certain threshold, which is age 62 and 20 years of service, you bump from 1% to 1.1% as a factor that we're using to calculate your pension. If you're close to age 62 and close to 20 years, generally it's worth your time to wait to get the extra 10% bonus. So let me just give you a quick example. We have a FERS employee, 30 years of experience, so 30 years of service, retiring at age 62, making $100,000 per year. So more than 20 years of service, age 62, they've met the threshold, they get 1.1% times the years of employment, 30, for a total of 33% of their average of their 3 highest paid years. In this case, it's $33,000 per year, and then you'll get a cost of increase adjustment attached to that from this point going forward. For those of you who retired in 2021 or before, you'll see the cost of increase adjustment was quite high coming up for 2022. I believe it was 5.9% for Social Security. All right, so survivor benefit options. We have 3, so it's a very rigid number of choices. We can reduce our unreduced annuity by 10%. That's going to protect our loved one 50% of the unreduced annuity. We can reduce our unreduced annuity by 5%, providing coverage of 25% to a survivor, or we pay nothing and the survivor gets nothing. Keep in mind that if you do choose one of option 2 or 3, your spouse does have to sign off on that. So let's give you a quick example. Sarah Williams has an unreduced annuity of $50,000, would like to leave the maximum 50% to her husband. 50% times 50,000, the survivor benefit is $25,000. The cost is 10% of her unreduced annuity. The cost in this case is $5,000. Over the course of Sarah's lifetime, she will probably pay in the neighborhood of, give or take, $150,000 to protect her spouse. 30 years times about $5,000 in cost per year, and that's not accounting for the COLA, which will affect the survivor benefit as well as the cost of the survivor benefit. All right, now let's talk about these old pensions. About 6% of the federal workforce is still part of the old pension system. The old pension system provides a flexible survivor benefit, much more flexible than the new system. It provides the ability to receive full retirement benefits at a couple years earlier, as early as age 55 versus 56 or 57 with the new pension programs. It provides access to the Voluntary Contribution Plan, which again is the way for you to superfund a Roth IRA with up to 10% of your lifetime earnings. If you have cash sitting aside, this is an excellent place to put it. I can go into a lot of detail on why this is and why this is a loophole, but we don't have enough time for that today. And then lastly, there are no Social Security benefits accrued as a CSRS employee unless they work outside the federal government and pay in separately. So how is it calculated? This is the CSRS calculation. The first 5 years are calculated at 1.5%. Next 5 years calculated at 1.75%. Every year thereafter is calculated at 2%. So for the first 10 years, you get 16.25%. After that, it's 2% per year. You're going to max out at approximately 80% plus accrued sick leave. That happens at about 41 years, 11 months of service. After that, for those people who've worked past 41 years, 11 months, money is actually deposited into that voluntary contribution plan that we talked about earlier. That's the whole purpose of why it was created. And there have been some loopholes generated off of that, which allows for that fully funding of the Roth IRA component. Give you an example of the CSRS annuity. We have an employee, 25 years of experience, retiring at age 60, making $100,000 per year, and we're going to assume that the $100,000 is the average of their 3 highest paid years. 16.25% for the first 10 years, 2% for the next 15 years, for a total of 46.25%, or in this case, $46,250. Now, this is one of the big benefits when we talk about survivor benefits of the old pension system. There is a tremendous amount of flexibility on how much you can leave to your spouse. You can go as high as 55%, but you can go really any point lower. For anybody who's looking to leave the federal health benefits to their spouse must receive some sort of survivor benefit, whether they need that or not. My typical recommendation is for you to choose the survivor benefit associated with the $3,600, which would provide a survivor benefit of $1,980. Now, why is that my recommendation? Because for some reason in the code, the cost per dollar of insurance is a quarter of that for any other insurance above the $3,600. I can't speak to why that is, but it is absolutely the best for the buck. Anything above the $3,600 is going to be 4 times more expensive per dollar of insurance. Okay. So let's give you a quick example of the CSRS survivor benefit. We have a federal employee who has an unreduced annuity of $50,000, would like to leave the maximum, which is 55%, to her husband. The first $1,980 is going to cost $90. This is the discount insurance. For whatever reason, it's discounted. Anything that you want after that amount is going to be 4 times the cost, and in this case, the next $25,520 will cost $4,640 for a total of $4,730, or about 9.46% for a survivor benefit of $27,500. So what is the survivor benefit? I mentioned this earlier. I'm just going to kind of bang home that point. The survivor benefit is, in exchange for a fixed reduction in your benefit, the fund will pay a portion of your pension to your surviving spouse. So it's guaranteed life insurance that is paid out over an extended period of time, and you cannot change the beneficiary. So important considerations. We've talked about how the concept of the survivor benefit through CSRS or FERS is similar to life insurance, but not quite the same. This is where we start looking at different options if we're still leading up to retirement, deciding what to do from a survivor benefit standpoint. Are you taking advantage of the federal health insurance benefits in retirement? Does your spouse need those? If your spouse needs the federal health insurance benefits, you must leave a survivor benefit to your spouse, whether that's in their best interest from a life insurance standpoint or not. For FERS employees or FSPS employees, that means that you have to take the 25% coverage for the spouse. For CSRS employees, you have a lot more flexibility. Again, I would recommend that $3,600 of benefit or times 55% or $1,980. Now, what is the most efficient way to transfer wealth to your heirs? And lastly, CSRS members, the Voluntary Contribution Plan. If you're still working, you're a CSRS employee, please definitely look us up. All right, so survivor benefits, a closer look. I'm going to simplify this quite a bit, but I'm trying to do this to make a point. All right, so let's look at the survivor benefit. As we talked about, the two big weaknesses of the survivor benefit is it does not pay out a lump sum, and you cannot change your beneficiaries. As we talk about this chart, I want you to think about your particular family situation. How does this affect you? What do you think the odds of each one of these scenarios happening to yourself and your spouse? So first off, we have the employee passes away a long time before the spouse. So odds are this happens if the employee is much older or the employee is in much worse health than the spouse. If this happens, the survivor benefit payout's going to be large because it's going to be a fixed amount of money for a very long period of time. It is 100% going to be worth it. But for you in your situation, what is the chance of that happening? Your spouse outliving you by 10 or 15 years. For most people of equal health and equal age, it's going to be less than 15%. The next scenario is the spouse passes away before the employee. If that happens, all the amount of money paid into the system from the survivor benefit standpoint, it disappears into the system. At the time of the spouse's death, the employee is then bumped back up to their unreduced annuity so that they're not charged anymore, but they don't get any of the money that they paid in already back. The payout on this is going to be zero. The last scenario, and this happens more often than you would think, especially for couples who've been married in excess of 25 years. The spouse and the employee pass away within a short period of time from one another. In this example, we're having the spouse pass away second to the employee. Because there's no lump sum benefit, the spouse will receive that monthly payment for a short period of time, months, if not a couple of years. Then the spouse passes away and it goes away. At the end of the day, that's probably not a good investment either. What are the odds in your household that it will happen? The odds of two similarly aged people who've been married for at least 25 years passing away within 2 years of each other is about 30%, just for your reference. All right, so now let's look at life insurance. The real benefit of life insurance is you can change your beneficiaries and the money is paid out lump sum. Somebody's going to get paid. We look at all three of those scenarios. Somebody that you love is going to get paid, whether it be your spouse or if something were to happen to your spouse, your children, or your charity of your choice. I'm not going to go into these scenarios one by one because at the end of the day, if you can change your beneficiary and if it's a lump sum payout, it's always coming out. All right, so an example of pension maximization. We have Tom, he's age 54, he's married. His wife is about 2 years older than him, age 56. Statistically speaking, they're going to be dying right around the same time. I know that sounds morbid, but from a financial planning standpoint, it is good to know. His desired retirement age is age 55. He's above average health. He's a CSRS employee, and he's a highly compensated CSRS employee with an expected annuity of $92,408. If he takes the full survivor benefit because he loves his wife, the survivor benefit is going to be $50,824, and it will reduce his annuity by $8,971. Tom wants to protect his wife financially in the event of his death. Tom also looks at the situation. He was a mathematical guy at the time, and he said, okay, what are the odds of Sue outliving me by an extended period of time? And the odds, frankly, were not great. So instead, what we decided to do was we decided to purchase a $300,000 guaranteed life insurance policy for about $3,600. We bought a 30-year level term policy for $805,000, with coverage of $805,000 for a cost of $4,676. For total stacked insurance policies of a little over $1.1 million at a cost of about $8,300, a little bit cheaper than the cost of the survivor benefit. What does that get them? It gets them a fixed amount of insurance guaranteed that will start off higher at age 65, will start off higher at age 85. The money can pass to non-spouses. The money can be split between different investments. The money can be split between heirs, and we know that a payout will occur. So that's the power of subsidizing the survivor benefit with life insurance. But I'm going to go back here. But as I said before, this relies on the idea in your particular situation on the probability that option 2 and option 3 will occur. If there is a very, very large age discrepancy between the employee and the spouse is 20 or 30 years younger than that of the employee, then we would recommend the survivor benefit almost every time. It depends on your situation and statistically how probable you are to make money off the survivor benefit. All right, moving back forward. All right, I'm going to say this one last time. Take note, even if an individual insurance policy is the best choice, if your spouse needs the federal employee benefit health benefits, they must receive a survivor benefit. It doesn't have to be large, but they must receive the survivor benefit. For CSRS, the minimum survivor benefit that we recommend is $1,980 at a cost of $90 per year. For FERS, it's a little bit more stringent. You would have to choose a 25% survivor benefit. For those couples that are both federal employees, there is no requirement that one person has to take a survivor benefit. Even if the health insurance is held by one person and not the other, because you're both federal employees, because you both had insurance going into retirement, if something were to happen to the employee that held the insurance, coverage would pass easily to the surviving spouse with no issues. People typically have that question. Hopefully I've answered it. All right, so other investment options. Your TSP. For those people who are in the new pension system, which again represents about 94% of the current federal population, you have access to the TSP with a match. Now the TSP has a number of very good qualities to it. The first and foremost is it is very, very inexpensive. Costs are somewhere in the neighborhood of 0.04%, which is going to make even the cheap mutual funds like Vanguard, Fidelity, and T. Rowe Price look expensive. The C fund, which is the S&P 500, should be in almost everybody's portfolio. The S fund, the total stock index, should be in almost everybody's portfolio. Very strong funds, ones that everybody should have. Now, there are some underlying weaknesses in the TSP, and as you move to retirement and you retire and are at least age 55, or you're still working and are at least age 59 and a half, you are able to move money out of your TSP when it makes sense. Some of the weaknesses associated with the TSP is the I fund. It is effectively legislatively handcuffed to not invest in some high growth sectors, primarily China and the Chinese sphere of influence. F funds, this is your safer bond funds. Because we're in historically low interest rates, typically active funds do better than passive funds, and the F fund is unfortunately a passive fund. The G fund, which on its face is a very good fund in how it's calculated. They calculate the rate based on the 10-year bond. The But because we're in a historically low interest rate environment, it's only paying about 1%. And in the outside world, you can do better. So I'm not saying you should move your TSP, but I think you should be very strategic in your investment choices, and you do have more options: retirement, post age 55, or while you're working, post age 59 and a half. Here are the rates of returns. As you can see, the average for the G fund is about 2.23%. It is paying far lower than that right now, though. The F fund, about 4% over the last 10 years. And as you can see, the domestic funds, which is typical to the industry, the C fund, the S fund, have been doing very well. International is lagging behind domestic, and the I fund in particular is lagging behind its international peers because it is unable to invest in things like China. All right, and then we have the L funds. The L funds are simply a diversified portfolio of the 5 funds: the C, the S, the I, the F, and the G. And they continue to tweak back the risk as you get closer to retirement. So let me just give you an example. The L 2050 fund has about 40% in the C, 13% in the S, 28% in the I. The L income fund, which is what people are withdrawing money from today, has about 71% in the safest investment they have, which is the G fund. Over the next 39 years, the L 2050 fund is slowly going to change until it looks a lot like the L income fund. I do want to point out to everybody that even though the L income fund says income, there is still an equity component. People always are a little bit confused by that. There are going to be funds in your portfolio that you're not going to spend for 15, 20, 25 years. And the market has never lost money over a 10-year period. So for some of those dollars that are not going to be spent for an extended period of time, those are dollars that you can take some risk in. And that's why you see the equity exposure. Also keep in mind that all target date funds like the L funds or life cycle funds, they're not created equal. The federal funds are historically much more conservative than their other counterparts. So if you were to compare the L income fund or the L 2050 fund within the TSP to that of Vanguard or Fidelity or T. Rowe Price, you would actually find that Vanguard, Fidelity, T. Rowe Price would actually have a much larger equity component and would be much more aggressive and frankly much riskier in how they've done their allocations. The L funds within the TSP are very conservative, also very international heavy. All right, next, the Special Retirement Supplement, also called the FERS Supplement, also called the Social Security Supplement. So what is it? When they switched over in 1986 from the old pension system to the new pension system, they created the three-legged stool, as I mentioned before. You had the TSP match, you had this smaller pension program, and you had Social Security. But then there was one problem with Social Security. The full retirement age with 30 years of service was 56 or 57, but I can't collect Social Security till age 62, which led to the creation of the Special Retirement Supplement. It was designed to bridge the gap between full retirement and age 62. And what they do is they take your number of years of service, they divide it by 40, and they multiply it by your age 62 Social Security benefit, and that's the amount that they're going to pay you per month, every month, until you reach 62, and then it'll stop. Whether you take Social Security or not at 62, that's your choice, but this payment stops at age 62. Give you a quick example. We have Jane Smith, a FERS employee, will retire with 30 years of creditable service. She has reached her minimum retirement age, which is 57. Her age Social Security benefit, age 62 Social Security benefit, will be $1,200 per month. So we take years of service divided by 40, that's 75%, times 1,200, that's $900. That's the FERS supplement. You do not get a COLA on the FERS supplement. And between the ages of 57 and 62, Jane will receive $900 per month. At 62, that money will stop, and then it's up to her whether she takes her Social Security benefit at 62 or she waits and lets it grow. All right, legacy planning. This truly is secondary to the topic at hand, which is, pension maximization and retirement planning. But again, I just wanted to whet your appetite on next steps. So let's think we're getting into retirement. We're making sure we're comfortable in retirement. We're going to be in retirement for probably 10 years because that's when we really start to level out our retirement income. The first 5 years of retirement are typically very travel and expense heavy. After that, people typically tend to slow down and have a firmer understanding of their costs going forward. Once we get to that point, then we can start talking about passing money to our heirs in the most efficient way. So what is legacy planning? It's the positioning of assets to efficiently transfer wealth to your heirs, in a mindful way. And when I say mindful way, I mean tax efficient. I mean making sure that our money is going to be handled in the way that we want to be. If our heirs are very young or not very good with money, we may need to put some guardrails on how that money can be spent. The purpose, maximizing wealth for surviving family, maximizing charitable donations, and in some cases, controlling your money post from the grave. In some cases, life insurance makes sense, so taking advantage of your health or your income or your tax bracket could make sense in the legacy planning process. So what assets do you leave your heirs? Typically, assets that heirs really like are assets that they don't pay taxes on. So Roth IRAs. Real estate, because currently under the current federal laws, you receive the step up at death, which means you don't pay taxes on any real estate earnings. Individual stocks, you get the step up for individual stocks, you're not going to pay taxes on the earnings of the stocks. A large percentage of mutual funds, most of that will receive a step up at death as well. That's what heirs typically like. What heirs typically do not like are things that they have to pay taxes on, especially with the passing of the Secure Act, because now TSPs and IRAs, they must be withdrawn over a 10-year period instead of lifetime like it used to be, which means there's a larger amount withdrawn, which means you're potentially reaching higher tax rates, which means more money going to taxes. So understanding your benefits. As a civilian federal employee, you have access to a lot of different benefits. The goal is to complement those benefits, to supplement them, to augment them, to make them the best benefits they can be for your individual customized needs. And with that, GIBA can help. We were put on this earth 64 years ago with that sole goal in mind, and we take that goal very seriously. So please, with any questions, reach out to us. If you're looking for a second opinion to bounce ideas off of, we're here to help. At the end of this presentation, there is a survey. So if you can please do me a favor, fill out that survey. Our presentations are only as good as the people that came before you. We take your words, your advice in these surveys very seriously, and we always try to make our presentations just a little bit better. So that is the presentation from me. Thank you very much for your time. At this point, I will open the floor to questions. There should be a question box in your, here we go. All right, looks like I have a number of questions. Please feel free to type in any other questions you have. All right, so first question is, if you have 5 times multiple options, we're talking about FEGLI here, do you need to reduce to basic at least 5 years before your retirement to keep the 25% of option A? So no. The choice of what to do with each options, including the basic, option A, option B, option C, they're all unique to each type of insurance. So what you do for the basic, option A, option B, those are, they're not going to change what you did with anything else. So you can maintain option B and not have a, and have the full reduction, let it drop to 25%. And on the same piece of paperwork, you can choose to reduce the reduction or not on option B. Hopefully that made sense. At what age is it beneficial to change to an outside policy rather than FEGLI? Well, as I said before, if you're looking at retirement planning, you're probably in your 50s. And if that's the case, you're pretty close to retirement. So we never really want to get rid of the basic side, and we typically never want to get rid of option A because they go into retirement and they ultimately remain free of charge at 25% of what they once were from a benefit standpoint. But for supplementing FEGLI with individual insurance outside of that, we find that the 50s is a pretty good place to hit it from a price standpoint. If you wait until your mid 60s, it gets overly expensive and kind of very hard to insure in a good price point. So in the 50s, preferably probably under 58 is what your goals are, but if you're in good health, we can stretch it higher. Will this recording be available to attendees? Yes, it absolutely will. I am married to another Fed who is retiring law enforcement officer. Okay, he's retiring next year at age 49. I like to verify we can transfer our family insurance to me, and if I pass before him, he can resume coverage. I've been led to believe he needed to take his insurance with him in order to keep it, and I need to take mine. So no, the answer is if you're a federal employee and you retire fully and you're fully covered, whether it be under your spouse's or your coverage, if something were to happen to your spouse, you can continue the coverage going forward. So that is not an issue. As long as you're receiving an annuity or getting paid as a federal employee, you don't have to worry about taking it separately into retirement. All right, so that is the last question at this point. We got about 1 or 2 more minutes before I'm going to sign off. Any other questions for me? Okay. Well, I just like to take the time to say thank you very much for your time. I know your time is very valuable, so I definitely appreciate you spending it with me. If you do have any other questions, I do mean very seriously, reach out to us. At Giba Wealth Management, our help is typically no obligation and free of charge. We are here to help. We can do things that as a nonprofit that other organizations can't, and we take that role very, very seriously. So thank everybody. I want to thank everybody. Have a great day. I'll talk to you soon.